Hello traders, welcome back to the channel. Take a look at these series of ranges that were formed and get shifted on the chart as the market moves to new price territories. What is it that you observe here? To be frank, this is a very important concept in SMC that you need to master in order to get your daily bias right and also to optimize your trade entries such that you buy at discounts and sell at premiums. So the main concept that I'm going to talk about in this video is regarding dealing ranges, and I will talk about displacement ranges also. So in this video, we will focus on dealing ranges, its key elements, its identification, potential trading setups that you can use, and then we will discuss displacement ranges and its identification and applications. But before getting started, I would like to ask you to give this video a like so that I can understand a majority of you are interested in learning these concepts. And if you are new to this channel or you have not yet subscribed, please make sure to subscribe and also enable the bell icon to receive notifications on our latest video updates. Now let's return to our video. Okay, let us first understand what dealing ranges are. We all know that SMC trading style focuses mostly on market structure and liquidity. Within the market structure, the dealing range is a concept where both buy-side and sell-side liquidities are taken out. A dealing range is simply a price range between a swing low and a swing high that takes out both the buy-side and sell-side liquidities. And it doesn't matter if this liquidity is a major liquidity or a minor liquidity. We will talk about this in a bit. But before that, let us understand the intention behind such range formations. Trust me when I say this. Dealing range theory or DRT is one of those SMC concepts that you need to master as a trader, especially if you are a beginner. The reason why I say this is because dealing ranges can help you wait for the right setup to form before taking a trade entry. Within the dealing range, the smart money institutions are focused on accumulation and distribution campaigns. These institutions have deep pockets and detailed data to track where the majority of liquidity sits within the swing highs and swing lows. Institutions and smart money use such ranges to manipulate retail traders. They manipulate price action, drive liquidity hunts, and influence major price movements. In fact, the market primarily moves between the dealing ranges to balance fair value gaps or to hunt liquidity by breaking highs and lows within these ranges. These smart money institutions are aimed at building positions at specific levels of premium and discount zones of a dealing range. We will come to this concept soon enough. Now, to better understand a dealing range, mastering the following elements is critical. These includes the market structure, liquidity, and premium and discount arrays or PD arrays. I have extensively covered all these topics in the previous season of the SMC course. I suggest you go back and watch them to brush up your memory. In short, when drawing the market structure, the dominant trends swing high and swing low are typically identified. The most important element in the swing low estimation is the break of structure, and that in the estimation of swing high is the price retracement below an inducement level for a bullish market structure. Likewise, the break of structure is the most important element in the estimation of a swing low, and for the estimation of a swing high, it is usually the price pullback above the inducement level. The change of character or market structure shift is another important element of market structure that signals a change in the dominant trend's nature. But one of the key components of dealing range is selecting the proper swing highs and lows. Now, the second thing you need to have a good grasp on is the concept of premium and discount areas. The dealing ranges are divided into premium and discount areas. We will make use of the Fibonacci levels to mark the range. There are three levels in the range. These are 0%, 50%, and 100% Fib levels. The 50% Fib level is considered as the equilibrium level. Now, in an uptrend, the discount area is below the equilibrium level, and the smart money players are more likely to buy in this area. Similarly, in a downtrend, the premium area is above the equilibrium level, and big players are more likely to sell in this area. Now, the most important component associated with the dealing range is liquidity and liquidity sweeps. So, as you may all know by now, liquidity sweeps are zones on the chart where large amounts of stop loss orders and pending orders accumulate, often forming within and outside of a dealing range. There are internal and external range liquidities. External range liquidity is the liquidity associated with the major swing highs or lows, while the internal range liquidities are associated with fair value gaps, order blocks, equal highs or lows, and internal highs or lows within the range. Liquidity is also classified into buy side and sell side liquidities based on where the orders are accumulated and what type of orders are accumulated near a level. Now, with an understanding of the main components that make up a dealing range, let us learn how to identify one. By definition, a dealing range is simply a price range between a swing low and a swing high that takes out both the buy side and sell side liquidities. We will begin with a bullish scenario. Like always, we will begin our analysis on a higher time frame chart. This is a 1 hour time frame chart that you are looking at, and the trend is bullish. Now, the most important point you need to keep in mind while looking for a dealing range is that your focus should be on the current price and not on the historic prices. This means you should focus on what the market is currently doing. Once you have that sorted out, you need to find the proper swing high and swing low for marking the dealing range. Now, the reason why I said proper is because you need a swing low that has already taken out a sell side liquidity, and you also need a swing high that has already taken out the buy side liquidity for marking a valid dealing range. For this, you need to check the new swing highs and lows with the previous swing highs and lows. So basically, we want the new swing low to take out a sell side liquidity pool. Since we are in a bullish market structure, we know that the old swing lows are considered as strong lows, which means the probability of price moving below these lows to sweep sell side liquidity is very low. So what are the other areas where we can expect to find sell side liquidity? Quite obviously, these include the equal lows and the internal low levels. We will find clusters of retail sell side liquidity below these areas. Now you can ask me, why not the fair value gaps and order blocks? Why are they not considered? If you have asked this question, then you are very sharp. So even though both order blocks and fair value gaps are considered as internal range liquidity, these are quite different from buy and sell side liquidities. To be more precise, fair value gaps highlight areas where price moved too fast, thereby skipping the liquidity, or it is simply an imbalance in prices that the market would return back to fill. Order blocks, on the other hand, show areas where institutions placed large orders. They represent institutional buying and selling zones. Now, when it comes to buy side and sell side liquidity pools, it represents areas where the retail traders have placed their stop losses and limit orders. Simply put, it all comes down to how the institutional players interact with these areas. Order blocks and fair value gaps are cost based, meaning they show where the institutions acted or where imbalances occurred, while buy or sell side liquidity is effect based, meaning they show where the retail traders are most vulnerable. So the point I want to make is that fair value gaps and order blocks are not the liquidity areas we are looking for. Instead, these are potential trading zones within a dealing range where we can plan our entries. Now, the buy and sell side liquidities can be found above equal highs or internal swing highs and below equal lows or internal swing lows respectively. The new swing low should either take out the liquidity below an old low or previous swing low, or else it should sweep the sell side liquidity clustered below an equal low or an internal low level. Then we need a swing high that sweeps the buy side liquidity. In a bullish market trend, we normally get a liquidity sweep above the previous swing high in the form of a bullish break of structure. Now, a break of structure in itself doesn't tell us where the swing high is. It does help out in figuring out where the swing low is. But to determine a swing high point, we need to make use of the concept of inducements. In fact, inducement is a concept that has multiple benefits when it comes to the identification of a dealing range. Simply put, inducement is considered as the first pullback after a break of structure has happened. Now, there may be different scenarios where we need to tweak this concept of inducement. For instance, in a strong bullish trend, price won't always retrace deep enough. In such cases, the level below the latest minor pullback that the market forms on the way up is just an inducement level. Likewise, there are occasions when market will not even form a pullback after a break of structure. Instead, there will be a minor pullback before the break of structure happens. In that case, the low below this minor pullback level will be our inducement level. But no matter what the situation is, we can consider a retracement as a valid one only when an inducement level is swept. In addition, only when an inducement level is swept can we properly determine our swing high level. So in this bullish scenario, we want to see price retracing below an inducement level to sweep the sell side liquidity available there. This does two things. First, we can confirm our new swing high level, and second, we get a sweep of our sell side liquidity. Now we have the swing high and swing low that we have been looking for, which has swept the liquidities on both buy and sell sides. Now to properly mark our dealing range for trading, we can make use of Fibonacci levels. So let's select the Fibonacci retracement tool from the left sidebar menu or from the favorite tool section in TradingView. Now start plotting from the lowest swing point and drag and select the highest swing point. Your Fibonacci levels will be plotted automatically. But we do not actually need all these levels. We just require the 0%, 50% and 100% Fib levels. You can go to the settings and change it accordingly, or you could save it as a template for easier access. Here I will use my save template. So this is our bullish dealing range. The high is called the dealing range high and the low is the dealing range low, while the 50% Fib level is the equilibrium level. Now, can you tell me why we did this? This was done simply to identify the premium and discount areas within the dealing range. So as a rule of thumb, if our bias is bullish, it would be ideal to take long trades from the discount zones. And if our bias is bearish, it would be ideal to take short trading opportunities from the premium areas. So the simple idea is to buy low and sell high. Now in this particular case, since we have a bullish market structure, we will wait for prices to fall back to the discount area of our dealing range. This means we can look to take long trades below the 50% Fibonacci level. But taking trades anywhere below the 50% Fib levels seems vague. So you need to make use of bullish PD arrays within the discount zone. It could be the old highs or lows, order blocks, liquidity voids, fair value gaps, breaker blocks, mitigation blocks, rejection blocks, etc. But primarily, I like to make use of fair value gaps and order blocks for trade entries. It's strictly personal. You can use what works for you. Now, fair value gaps represent imbalances in prices. These market imbalances will act like magnets, attracting prices towards it. You could also look for order blocks along with fair value gaps within the discount area of the dealing range. Now, once you have identified a fair value gap within the discount zone, there is a very high chance that prices would pull back deep enough to fill these imbalances completely or partially. Now, this is not 100% guaranteed. There are occasions where price could keep heading higher without retracing back to these discount zones. In such cases, the best course of action is to either wait patiently or else try using displacement ranges to ride short-term pulses. We will talk about displacement ranges in a short while. Now here, you can see the price retracing into the discount zone of our dealing range, and then it mitigated a fair value gap and started to reverse back higher. You can enter a long trade either from the high of the fair value gap or from the consequent encroachment level. You can then set your stop loss below the low of the fair value gap or even below the lower swing level. Our profit target would be the next draw on liquidity, which in this case is the previous swing high where buy-side liquidity is present. But you can significantly improve your odds of getting into a profitable trade by using the lower time frame market structure shift. I have talked about this in the recap episode of this season. The idea is to use the fractal nature of market. So if you are looking at the market structure in a higher time frame chart, such as the 15-minute chart, then you should switch to a lower time frame chart, such as a 1-minute or 3-minute time frame chart. Now you'll be able to see the fractal nature of prices. Most probably, you will observe price forming lower lows and lower highs during the retracement or pullback move. Now, all you have to do is to wait for a change of character or a market structure shift in this lower time frame structure. But make sure that this shift in structure towards bullish price movements happen within a price of interest like a fair value gap or order block. So when you align your long trade entry with a market structure shift and a price of interest, you will get a high reward low risk setup. In this case, take the long trade entry after the bullish change of character. You can place your stop loss below the lowest point before the market structure shift happened. Your take profit level would be the next draw on liquidity on the higher time frame structure. In this case, it would be the next swing high where the external buy side liquidity is present. I hope things are making sense. Now let's see what the price did. The price moved higher, broke above the old swing high to sweep the buy side liquidity, thereby forming another bullish break of structure. So now our swing low is confirmed, which has already taken out the sell side liquidity available below the previous inducement level, which was a minor swing low level. The price has then swept the buy side liquidity also. Now all we need is for the price to take out the inducement level such that our swing high is also confirmed. This way we can get the high and low of our new dealing range. You can use a Fibonacci retracement tool to plot the premium and discount areas within this new dealing range. Now our focus should be to take long trades from the discount zone by utilizing the PD array components like bullish fair value gap or bullish order block. Now a bonus tip here. When price retraces down during a bullish market structure, it could take out multiple sell side liquidity pools clustered below minor swing lows or below equal lows. This is more prominent if you are doing your analysis on a much lower time frame, such as 15 minutes for the purpose of intraday trades. No matter what the situation is, what matters is that the swing low formed should have taken out some sort of sell side liquidity. Another point to keep in mind is that the price could pull back deep enough to sweep the sell side liquidity below the major swing low, but it should not break and close below the low. In such a case, it is an indication that our main trend has shifted from bullish to bearish, and this is a bearish change of character. In that case, our previous dealing range gets invalid and we need a new dealing range that aligns with the newly formed trend. But I won't be talking about a bearish scenario because the process is the same. All you need to do is to identify a swing high which has already taken out a buy side liquidity above an old high, internal high, or an equal or relative high. Then you need to figure out a swing low point formed after a bearish break of structure which has swept the sell side liquidity. You can make use of inducements for this purpose. Once an inducement level is swept, your lower low gets confirmed. Then use a Fibonacci retracement tool to draw a bearish dealing range from the swing high to the swing low point. The area above 50% Fibonacci level is our premium zone and below the equilibrium is our discount zone. Since our bias is bearish, we will look for short trade entries from within our premium zones with the help of any of the 7 PD array elements. It could be from a bearish fair value gap or from a bearish order block, etc. Now let me quickly walk you through an example on how to draw dealing ranges and how to shift dealing ranges in a bullish market scenario. So here we have a bullish structure on a 1 hour time frame. So here you can see that the market created a bullish break of structure and swept the buy side liquidity. But before that, market swept the sell side liquidity below a minor low, which turns out to be an inducement level. So after the breakout, the lowest point which took out the sell side liquidity will be our dealing range low. Now after the structure break, price formed an inducement in the form of first pullback, and then price came back down to sweep the sell side liquidity below this inducement low. Now our dealing range high is also confirmed. So we can plot a Fibonacci retracement from the low to the high point to get the premium and discount zones of our dealing range. You could look for bullish trade entries from any PD array element within the discount range of this dealing range, such as a fair value gap or order block. Now once again, price moved up higher to break above the previous high and swept the buy side liquidity. This will confirm the low of our new dealing range. After a bullish break of structure, wait for an inducement to be taken out to validate a new dealing range high. Once again, using a Fibonacci tool, plot the premium and discount areas. This will be our new dealing range. In this case, price didn't move deep into the discount zone because there was sell-side liquidity on offer below a minor consolidation, and there was also a fair value gap close to the equilibrium zone. But the important thing here is that the price has swept the sell-side liquidity. Then again, the market moved higher, formed a structure break, and took out the buy-side liquidity. The dealing range low is confirmed. When the inducement is taken out, our dealing range high also gets confirmed. Plot the new dealing range using Fibonacci. In this case, price retraced deep enough, taking out all the internal sell-side liquidities near the minor lows, and then moved even lower to sweep the sell-side liquidity below the previous low, and then only it reversed. So the point that I want to make is that despite having order blocks or fair value gaps on the way, there is always a possibility that the market could break past all these zones and draw into the external pool of liquidity. Now again, the price moved higher and it swept the buy side. Our dealing range low is confirmed. Then the market retraced to take out the inducement. The high of the range is also confirmed. Now mark the dealing range and wait for the price to pull back into the discount zone for you to enter into a long trade position. In this case, price took the sell side liquidity below the inducement level, moved lower into the discount zone of our dealing range, and then reversed higher after mitigating a fair value gap. Now using this technique, you can mark dealing ranges for the rest of the chart also. I recommend you try this out on your own on multiple charts to see if it actually works for you. Now let's say there is a bearish change of character. In that case, our bias has shifted and we will only look for bearish dealing ranges. Now let's quickly talk about displacement ranges. You may be familiar with what displacement moves are. Simply put, price displacements are large impulsive moves formed by large bodied candles with minimal retracements or wicks, often leaving fair value gaps or liquidity voids behind. These displacement moves confirms institutional intent in taking prices higher or lower depending on the market sentiment. If you have understood what displacement moves are, then figuring out a displacement range won't be a challenge at all. Just identify a displacement move such as this in prices, then connect the lowest and highest points in the displacement move with a Fibonacci tool. By doing so, you can get an idea about the premium and discount areas within the displacement ranges. Let us understand this with the help of a bullish displacement range. Usually, a displacement move occurs in the market when price has swept some form of liquidity. It could be an external or internal range liquidity, and the candles associated with the displacement move are strong bullish candles with large real bodies with little to no wicks. So we need to spot such a series of strong bullish imbalance candles. Then you need to identify the starting point or the low of this bullish displacement move, and you also need to mark the high of this displacement move. Now use the Fibonacci tool to connect the lowest and highest point of the displacement move. We only require the 0%, 50% and 100% Fib levels. Now this becomes our displacement range. Similar to dealing ranges, here also the area below the 50% equilibrium level is the discount zone and above the 50% is the premium zone. Now what should we do with this range? The idea is to wait for the price to pull back at least to the 50% Fib level or to the discount zone. During a bullish displacement move, price would have created bullish fair value gaps on the way up. We can anticipate a price retracement to these imbalances to fill these imbalances completely or partially. So we can try to take long trade entries from or below the equilibrium level. Now for optimizing your trade entries, you could also move down to your lower time frame chart and look for a bullish market structure shift after the price pullback to confirm a reversal in the actual trend direction. Once this is confirmed, you can take your long trade entry and you can keep the stop loss below the lowest point before the minor structure shift happened. And our first target in this case would be the displacement range high. Now, one interesting thing about displacement ranges is that it is either formed within a dealing range or else it could be equal to the dealing range. Either way, just like with dealing ranges, we will only consider the most recent price action for plotting displacement ranges. So once our displacement range is done and dusted, it is no longer useful and we will have to shift to a new displacement range as and when it occurs. Now, the same concept applies to bearish displacement ranges as well. So most probably, you will find bearish displacement moves during a bearish market structure. Once you have identified the displacement move with strong bodied bearish candles, you can now connect the highs and lows of this displacement move using a Fibonacci tool that will split the range into two zones. The area above the 50% Fib level is the premium zone, while the area below it is the discount zone. Since the overall market sentiment is bearish, we will look for short trade opportunities when price retraces back at least to the equilibrium level or into the premium zone. You could refine your trade entry by moving down to a lower time frame chart and wait for a bearish structure shift to happen within the premium zone. You could enter a short trade and set your stop loss above the highest point before the minor structure shift happened. Our initial profit target would be the low of the displacement zone. I hope things are clear now. So this is all you need to know about dealing and displacement ranges. In the next episode, I will talk about optimal trade entry, which is a very useful SMC trade entry method that can provide you with highly rewarding trades with minimal risk. So stay with us to find out. Meanwhile, if this video was informative, kindly hit the like button so that the YouTube algorithm knows that you are interested in these type of videos. If you have any doubts or suggestions, do mention it in the comment section and share this video with your friends and fellow traders. And if you are new to this channel or you have not yet subscribed, please make sure to subscribe to help us complete the 1 million goal by the end of 2025. I will see you guys in the next episode. Till then, bye.